Today, we're diving into a paper that turns a core investment belief completely on its head. So, imagine the market's crashing. What do? Conventional wisdom usually says one thing. Right. You've heard it from the greats. Be greedy when others are fearful. In other words, buy the dip. But what if the data says to do the exact opposite? That's what this 2017 paper suggests. The idea is actually super simple. You take less risk when the market's volatile, more when it's calm. It's really just a two-step process. First, you measure last month's volatility. Then, you just scale your investment based on that. Less risk for choppy markets, more for calm ones. So back in 2008, this strategy would have cashed out almost completely, the total opposite of buying the dip. Okay, so why on earth does this work? Well, it all boils down to one key market disconnect. Check out this chart from the paper. As past volatility rises, future volatility rises right along with it. But here's the kicker, future returns barely move, so there's a strong link to future risk, but a really weak link to future reward. You're just not getting paid enough for that extra risk. And when you actually exploit this, the results are, well, they're pretty staggering. Let's see the numbers. This strategy generates huge alpha. That's just risk-adjusted returns on top of the market's baseline. For the overall market, we're talking an extra 4.9% in annual returns. That's a huge deal. And for a momentum portfolio, it jumps to an incredible 12.5% per year. Over the long haul, this difference compounds into something massive. Let's see how it plays out. A single dollar from 1926 becomes $4,000 with buy and hold. With this strategy, $20,000. For the average investor, this all translates to a massive 65% increase in lifetime investment utility. And here's the thing. This isn't just some clever trading trick. It pokes holes in major financial models. Seriously, our most sophisticated theories of how markets work, none of them can really explain these results. See, those models all assume that when things get scary, the reward for taking on risk should shoot way up. But this paper's data shows that link is actually pretty weak. The market's price of risk isn't what we thought. Which, of course, leaves us with one huge provocative question. If this is so simple, why isn't everyone doing it?